Welcome, curious minds. Today, we embark on a thrilling journey through the dark underbelly of the financial world. In this captivating video, we'll unveil the top 10 biggest financial crimes that have shocked the world with their tales of greed, deception, and audacious schemes. Hold on tight as we delve into these shocking accounts. Let's get started. Number 1. Ponzi scheme madness. Our first point takes us into the infamous realm of Ponzi schemes. We'll explore the audacious actions of notorious fraudsters like Charles Ponzi and Bernie Madoff, unraveling their intricate web of deceit and the devastating consequences that unfolded. To understand a Ponzi scheme, we must first grasp its fundamental concept. At its core, a Ponzi scheme is an investment scam that promises high returns to early investors using funds collected from later investors. The scheme's success relies on a continuous influx of new investors to sustain the illusion of profitability. Ponzi schemes often begin with a charismatic mastermind, an individual who exudes charm, confidence, and an aura of credibility. We'll explore how these schemers leverage their personalities to gain the trust and confidence of potential investors. The allure of a Ponzi scheme lies in the promise of extraordinary returns. We'll uncover how schemers use enticing investment opportunities, claiming high profits with little risk. These promises, however, are mere illusions, as the returns are generated from the money contributed by new investors rather than legitimate investment activities. As the scheme progresses, it forms a pyramid-like structure. Early investors may receive the promised returns, bolstering the scheme's credibility. However, beneath the surface, there's an unsustainable reliance on new investments to fulfill obligations to earlier participants. When the influx of new investors slows down or stops, the scheme collapses. When a Ponzi scheme collapses, it leaves a trail of destruction. Investors, often left in shock and disbelief, realize that their money has vanished. We'll examine the financial and emotional toll on victims as their savings and dreams are shattered. Throughout history, there have been several iconic Ponzi schemes that have captured the world's attention. We'll explore some of the most notorious cases, from Charles Ponzi's scheme in the 1920s to more recent examples like Bernie Madoff's colossal fraud. Number 2. Insider trading scandal. Next, we'll uncover the world of insider trading scandals that have rocked the financial industry. From high-profile cases involving corporate executives to influential investors, we'll reveal the shocking tactics used to gain unfair advantages in the market. To grasp insider trading, we must first understand its essence. Insider trading occurs when individuals trade stocks or securities based on non-public material information. This gives them an unfair advantage over other market participants, compromising the integrity and fairness of financial markets. Central to insider trading is material non-public information, a significant piece of information about a company that could impact its stock price once revealed to the public. We'll explore how privileged individuals gain access to such information, often due to their positions within the company or close relationships with insiders. Insider trading takes various forms, each with its own modus operandi. We'll delve into the mechanics of insider trading, including classic scenarios such as trading ahead of earnings announcements, mergers and acquisitions, or regulatory decisions. We'll also explore the use of intricate trading schemes and hidden accounts to disguise illicit activities. Throughout history, numerous high-profile insider trading cases have sent shockwaves through the financial world. We'll explore notable examples such as the case of Martha Stewart, Raja Rajaratnam, and the infamous Wall Street insider trading scandal. These cases highlight the far-reaching impact of insider trading. Number 3. Money laundering mastermind. Money laundering, a crime lurking in the shadows, takes the spotlight in this segment. We'll explore the sophisticated methods employed by criminal organizations and even legitimate institutions to disguise the origins of illicit funds. Throughout history, several high-profile money laundering cases have shocked the world and exposed the depth of this illicit activity. Let's take a closer look at one of the most famous incidents, the Anambeb scandal. The Anambeb scandal refers to the multi-billion-dollar corruption scandal that unfolded in Malaysia in the early 2010s. It involved the misappropriation of funds from the country's state investment fund, One Malaysia Development Berhad Onambu High, ranking officials and their associates. The exposure of the Wanamab scandal triggered extensive investigations by regulatory bodies and law enforcement agencies worldwide. Authorities from different countries, including the United States, Switzerland, and Singapore, pursued legal actions and seized assets linked to the illicit funds. The fight against money laundering requires a multifaceted approach involving education, legislation, and technology. We'll explore how individuals, organizations, and governments can contribute to this ongoing battle by raising awareness, supporting anti-money laundering efforts, and advocating for stronger regulations. Number 4. Corporate fraud galore. Corporate fraud has shaken the foundations of major companies, and we'll examine some of the most infamous cases. Uncover the deceitful accounting practices, fraudulent schemes, and corporate collapses that left investors reeling. Corporate fraud refers to deceptive and illegal activities committed by individuals within a company to deceive stakeholders, manipulate financial records, or misrepresent the company's true financial health. We'll explore the motivations behind corporate fraud and how it undermines trust in the business world. Corporate fraud takes various forms, each with its own modus operandi. We'll delve into common types of corporate fraud, including financial statement fraud, insider trading, embezzlement, and bribery. Understanding these tactics helps us comprehend the extent of the problem. One of the most infamous corporate fraud cases in history is the Enron scandal. Enron, once considered one of the largest energy companies in the world, crumbled under the weight of its fraudulent practices. The Enron scandal unfolded in the early 2000s when it was discovered that the company's executives had engaged in accounting fraud, hiding debt, and inflating profits to deceive investors and stakeholders. The scandal not only led to the collapse of Enron, but also sent shockwaves throughout the business community. The fallout from the Enron scandal was significant. Thousands of employees lost their jobs, investors suffered massive financial losses, and trust in the financial system was severely shaken. The incident led to increased scrutiny of corporate governance practices and the implementation of more stringent regulations. Investor protection and due diligence became paramount in the aftermath of the Enron scandal. The incident highlighted the need for investors to conduct thorough research, question financial statements, and perform due diligence to protect themselves from potential fraudulent schemes. Number 5. Mortgage fraud machination. The housing market has not been immune to financial crimes, as we'll see in this segment. We'll expose the mortgage fraud machinations that led to the 2008 global financial crisis, along with other notable cases of fraudulent lending practices. Mortgage fraud occurs when individuals or groups intentionally deceive lenders, borrowers, or other parties involved in the mortgage process for financial gain. We'll uncover the various types of mortgage fraud, including fraudulent applications, property flipping schemes, and equity skimming to gain insight into this pervasive crime. Mortgage fraud has far-reaching consequences, not only for individuals directly involved, but also for the housing market and the economy as a whole. We'll examine how mortgage fraud contributes to inflated property values, destabilizes financial institutions, and leaves innocent borrowers and investors with heavy financial burdens. One of the most notorious incidents related to mortgage fraud is the subprime mortgage crisis, which unfolded in the mid-2000s and had a profound impact on the global economy. The subprime mortgage crisis stemmed from a combination of reckless lending practices, fraudulent activities, and the securitization of subprime mortgages. It led to a catastrophic collapse in the housing market, resulting in mass foreclosures, financial institution failures, and a severe economic downturn. The subprime mortgage crisis prompted a wave of regulatory reforms and increased oversight of the mortgage industry. Stricter lending standards, improved risk management practices, and enhanced consumer protection measures were implemented to restore stability and prevent fraudulent activities. Number 6. Rogue traders gone wild. Rogue traders have wreaked havoc on financial institutions, and we'll shed light on their wild exploits. From Nick Leeson's infamous actions that brought down Barings Bank to other rogue traders' risky bets, we'll uncover the tales of financial ruin. Rogue traders are individuals who engage in unauthorized and risky trading activities, often taking advantage of loopholes and lax oversight within financial institutions. We'll delve into the psychology and motivations behind their actions, seeking to understand what drives them to gamble with vast sums of money. One of the most famous incidents involving a rogue trader is the case of Nick Leeson and the collapse of Barings Bank. Leeson's unauthorized trading activities led to staggering losses and ultimately resulted in the downfall of one of the oldest and most esteemed banks in Britain. Nick Leeson's wild bets in the futures markets, particularly in Japanese Nikkei 225 futures, went unnoticed for a considerable period. The losses he incurred reached astronomical levels, revealing the glaring lack of risk management and internal controls at Barings Bank. The incidents involving rogue traders have had a profound impact on the financial industry, leading to significant introspection and regulatory reform. Authorities have tightened regulations, enhanced risk management practices, and improved internal controls to prevent similar incidents in the future. Despite efforts to prevent rogue trading, the threat persists. We'll discuss the ongoing challenges faced by financial institutions in detecting and preventing unauthorized trading activities and the constant need for vigilance and robust risk management practices. Number 7. Forex manipulation shenanigans. The foreign exchange market isn't immune to financial crime, as we'll discover in this segment. We'll delve into the manipulation of currency markets by major financial institutions, revealing the impact on global economies and unsuspecting investors. The most notable incident in forex manipulation involved several major banks colluding to manipulate foreign exchange rates. This scandal, often referred to as the forex rigging scandal or forex cartel, exposed the dark underbelly of the currency market. The collusion involved traders from different banks, forming secret chat groups where they shared confidential information and coordinated their trading activities. Their goal was to manipulate currency exchange rates to benefit their respective institutions. This covert coordination allowed the traders to manipulate the forex market in their favor, leading to unfair pricing and potential losses for other market participants, including individuals, corporations, and institutional investors. The impact of the forex manipulation scandal was significant and far-reaching. It eroded trust in the integrity of the financial markets and highlighted the need for stricter regulations and surveillance measures. As a result of the scandal, numerous banks faced hefty fines and legal repercussions. The investigations and legal proceedings that followed exposed the extent of the manipulation, leading to a wave of regulatory reforms within the financial industry. The forex manipulation scandal highlighted the importance of investor protection and education. Investors were urged to be cautious and informed when participating in the forex market, and educational initiatives were launched to enhance understanding of the risks and pitfalls. Number 8. Insurance fraud unveiled. Insurance fraud is a pervasive crime that affects both individuals and companies. We'll unveil the various forms of insurance fraud, including staged accidents, false claims, and elaborate scams that have cost insurance companies and policyholders billions. Insurance fraud comes in various shapes and sizes, from staged accidents and false claims to elaborate schemes designed to deceive insurers. These fraudulent activities have far-reaching consequences that extend beyond monetary losses. One of the most infamous incidents involving insurance fraud is the case of the Gone in 60 Seconds auto theft ring. This elaborate scheme involved a network of criminals who systematically stole high-end vehicles and orchestrated their disappearance through fraudulent insurance claim. The Gone in 60 Seconds gang meticulously planned their thefts, targeting luxury cars and executing them with precision. They would then file false claims, collecting large sums of money from insurance companies for vehicles that no longer existed. The impact of insurance fraud is profound, affecting both insurance companies and policyholders. Insurance fraud leads to increased premiums as insurers pass on the costs of fraudulent claims to customers. It erodes trust in the insurance industry and strains resources that could otherwise be used for legitimate claims. Insurance fraudsters employ various tactics to carry out their fraudulent activities. These can include staging accidents, inflating claims, submitting false medical bills, and even orchestrating arson to claim insurance money for property damage. These tactics are designed to deceive insurers and exploit vulnerabilities within the claims process. They not only result in financial losses, but also disrupt the insurance ecosystem, making it harder for genuine claims to be processed efficiently. Policyholders also play a crucial role in preventing insurance fraud. By remaining vigilant and reporting suspicious activities, individuals can contribute to the fight against fraudulent claims. It's essential to verify information, document accidents, and be cautious of unsolicited offers or services that may be part of a fraud scheme. Number 9. Identity theft and cybercrime. In the digital age, identity theft and cybercrime have become significant financial threats. We'll explore the world of hackers, data breaches, and online scams, exposing the staggering financial losses and personal devastation they cause. One of the most notorious incidents involving identity theft and cybercrime is the massive Equifax data breach that occurred in 2017. Equifax, one of the largest credit reporting agencies in the United States, suffered a cyber attack that exposed the sensitive personal information of approximately 147 million people. The Equifax data breach not only compromised individuals' personal data, but also highlighted the vulnerabilities within the data security practices of large corporations. It underscored the importance of robust cybersecurity measures and the need for individuals to safeguard their personal information. The impact of identity theft and cybercrime is far-reaching. Financially, individuals may suffer significant losses due to fraudulent transactions, unauthorized access to bank accounts, or the misuse of credit cards. Moreover, victims may endure emotional distress, damaged credit scores, and the time-consuming process of reclaiming their stolen identities. Identity thieves and cybercriminals employ various methods to carry out their malicious activities. These can include phishing emails, where victims are tricked into providing sensitive information, or malware attacks that compromise computer systems and steal data without the victim's knowledge. Additionally, hackers may target businesses and organizations to gain access to customer databases, compromising the personal information of countless individuals. These stolen data sets are then sold on the dark web, fueling a vast underground economy of stolen identities and financial information. Preventing and mitigating the risks of identity theft and cybercrime requires proactive measures. Safeguarding personal information using strong and unique passwords, being cautious of phishing attempts, and regularly monitoring financial statements are crucial steps in protecting oneself against these threats. Number 10. Embezzlement and white-collar theft. Our final point shines a spotlight on embezzlement and white-collar theft, revealing the actions of trusted individuals who abused their positions for personal gain. We'll explore the staggering sums stolen and the far-reaching consequences for businesses and investors. One of the most notorious cases of embezzlement in recent history is the scandal involving Bernard Madoff. Madoff was a prominent American financier and former chairman of the Nasdaq Stock Exchange. In 2008, his elaborate Ponzi scheme, spanning decades, came crashing down, causing billions of dollars in losses. Bernard Madoff's Ponzi scheme involved enticing investors with promises of high returns. However, instead of investing their funds, he used new investors' money to pay returns to earlier investors, creating an illusion of profitability. The scheme unraveled when the financial crisis hit and investors began demanding their money back. The consequences of embezzlement and white-collar theft are vast and impactful. Beyond the immediate financial losses suffered by victims, these crimes erode trust in institutions, jeopardize employees' livelihoods, and shake the foundations of the financial system. The fallout can extend far beyond the initial fraud, leaving a lasting legacy of damaged lives and shattered dreams. Detecting and preventing embezzlement and white-collar theft requires robust internal controls, financial audits, and vigilant oversight. Organizations must implement checks and balances, enforce strict ethical standards, and encourage employees to report suspicious activities without fear of retaliation. Individuals involved in embezzlement and white-collar theft face severe legal consequences. Prosecution and punishment can range from hefty fines and asset forfeiture to lengthy prison sentences. These penalties send a strong message that financial crimes will not be tolerated. Building a culture of transparency and accountability is vital to prevent embezzlement and white-collar theft. By promoting ethical behavior, encouraging whistleblowing, and nurturing a work environment where integrity is valued, organizations can mitigate the risks associated with these crimes. Congratulations on joining us in this riveting exploration of the top 10 biggest financial crimes in the world. These tales of greed, deception, and audacity serve as a stark reminder of the importance of ethical practices and regulatory oversight in the financial world. If you found this video enlightening, don't forget to give it